I have told the Secretary I could always sell 2 million barrels of oil to someone else other than the United States if they would like us to.
Canada's most significant form of geopolitical hard power is energy.
In the opening months of 2025, Canada made a quiet but powerful move that is already shaking the foundations of the global oil market. For years, it was seen as one of America's most reliable energy partners, always ready to send millions of barrels of crude oil south across the border. But now, that loyalty is being rewritten. Without making too much noise, Canada has started sending a large portion of its oil exports not to the United States, but across the Pacific. The destination, Asia. This shift didn't happen overnight. It was the result of growing frustration and missed opportunities. Canada waited patiently while Washington delayed and eventually canceled major pipeline projects, including Keystone XL. At the same time, trade tensions increased. Tariffs were imposed. Deals fell through, and Canada began to realize something important. Depending on one single customer, even one as big as the U.S., was becoming a risk. That's when the Trans Mountain expansion came into play. A pipeline project that had once been a source of political debate suddenly became the centerpiece of Canada's new strategy. By increasing capacity to ship oil from Alberta's oil sands to the western coast, it opened a direct path to Asia's booming markets. China, India, Japan, they're all hungry for oil, and Canada now has a way to deliver it straight to their ports. It's not just a change in direction, it's a change in mindset. This decision marks a turning point. For the first time in modern history, Canada is positioning itself not as America's energy backup, but as a serious independent player in the global energy game. And this redirection is already having consequences, both for Canada's future and for the fragile energy relationship between Ottawa and Washington. For decades, the relationship between Canada and the United States in the energy sector seemed unbreakable. It was built on proximity, trust, and shared infrastructure. American refineries, especially those in the Midwest and Gulf Coast, were designed to handle the heavy crude that flowed steadily from Alberta. Canadian oil made up more than half of all U.S. imports, becoming not just a source of fuel, but a foundation of energy security. In Washington, this partnership was often taken for granted. But behind closed doors in Ottawa and Calgary, frustration had been growing for years. The cancellation of Keystone XL in 2021 marked a major rupture. The project, years in the making and billions of dollars deep, was supposed to be a symbol of cooperation. Instead, it became a casualty of shifting political winds, environmental pressures, domestic politics, and a changing climate agenda in the U.S. killed it off, leaving Canada with stranded assets, economic losses, and a bitter sense of betrayal. That moment planted a seed. If the U.S. could walk away from a deal this big, what else might it abandon in the future? As the years passed, other stress points emerged. Tariffs on Canadian steel and aluminum, disputes over energy pricing, regulatory hurdles that blocked or delayed joint projects. Ottawa began to see a pattern, not of partnership, but of dependence. And dependence in the world of global energy is dangerous, especially when your only major buyer has shown it's willing to change the rules without warning. So, when the Trans Mountain pipeline expansion finally came online in May 2024, it wasn't just an infrastructure win, it was a strategic breakthrough. The expansion added nearly 600,000 barrels per day of new capacity, pushing Canadian crude from the landlocked oil sands to a deepwater port on the Pacific coast. From there, it could be loaded onto tankers bound not for Texas, but for Tianjin, Mumbai, Yokohama. By early 2025, those ships were moving fast. China imported more than 7 million barrels of Canadian oil in a single month. India and Japan weren't far behind. And with every shipment, Canada was sending a clear message. It was no longer satisfied playing second fiddle to U.S. energy priorities. It was time to diversify, to expand, to seek out new allies and new deals. This shift isn't just about money or markets, it's about power. Energy is leverage, and for years, the U.S. held most of it. Now, Canada is redistributing that leverage, offering reliable, long-term supply to Asia while strengthening its own negotiating position. For China, Canada's oil is more than a commodity. It's an alternative to Middle Eastern volatility and American unpredictability. For India and Japan, it's a chance to lock in new partnerships with a country seen as stable, resource-rich, and politically neutral. Meanwhile, in Washington, alarm bells are ringing. U.S. policymakers are watching as a once automatic flow of oil begins to shift direction. And they know what that means. Less control, higher prices, and more uncertainty in a market already rocked by inflation and supply chain instability. As Canadian oil finds new destinations overseas, the impact on the United States is becoming harder to ignore. For years, American energy security was built on the assumption that Canadian supply was not only constant, but guaranteed. That assumption is now cracking. The volume of crude flowing from Canada to the U.S. is projected to fall by nearly 1 million barrels per day, bringing levels to their lowest point in over a decade. This isn't a temporary dip. It's a structural shift, and it's sending shockwaves through the American refining industry. Many U.S. refineries, especially those built to handle heavy crude, aren't easily adaptable. They were calibrated for the specific composition of Canadian oil, which is dense and high in sulfur. Shale oil produced domestically in places like Texas is far lighter and lacks the same chemical profile. Reconfiguring these refineries is expensive, time-consuming, and in some cases, nearly impossible. That leaves the U.S. facing a difficult choice. Either import more from unstable regions like Venezuela and parts of the Middle East, or risk major disruptions to refinery output. And those disruptions are already being felt. Gasoline prices are rising, crossing the $4 per gallon mark in several U.S. states. Supply chain logistics are tightening, and oil-dependent industries are starting to cut costs. From manufacturing to transportation, the effects of this energy squeeze are trickling through the economy. What was once a stable, predictable source of supply has now become a question mark, and for policymakers in Washington, the timing couldn't be worse. All of this is unfolding as China takes center stage in the new oil equation. The Chinese government has been watching North America's energy politics carefully, and it didn't waste time when the opportunity arose. With the U.S.-China trade war escalating and tariffs climbing to record levels, Beijing needed a new way to secure stable oil flows. Canada offered the perfect solution, not just because of proximity, but because of alignment. Canadian crude fits perfectly with China's complex refineries, many of which were designed to process the heavier blends once imported from Iran and Venezuela. But those sources have become politically toxic or economically unreliable. Canadian oil, on the other hand, is low drama. It arrives on time. It's sold at competitive prices. And most importantly, it doesn't come with the same geopolitical baggage. Chinese imports of Canadian crude are now surging. If current trends hold, Canada could soon become China's third-largest oil supplier, just behind Russia and Saudi Arabia. That would have been unthinkable 5 years ago. But today, it's a very real possibility. And it speaks to something bigger than just trade. It speaks to a global realignment. By turning east, Canada is not only tapping into a more lucrative market, it's also stepping into a power vacuum. As the U.S. becomes more internally focused and increasingly tangled in its own domestic disputes, China is extending its reach. Energy is one of the tools it's using to do so. And Canada, perhaps unintentionally, is helping build the infrastructure for that expansion. For the U.S., this is a wake-up call. The oil that once flowed freely from its northern ally is now being loaded onto tankers bound for ports in Asia. The influence it once had is slipping. And for the first time in generations, the U.S. is being forced to reconsider its assumptions, not just about energy, but about its own role in a rapidly changing world order. While much of the spotlight has been focused on China's deepening energy ties with Canada, it's not the only nation making strategic moves. India and Japan, both heavily reliant on imported oil, have quickly followed suit, recognizing the same opportunity that Beijing seized. What's unfolding isn't just a set of individual trade deals. It's the quiet formation of a new energy triangle across the Pacific, one that could reshape the global oil market and reduce the West's dominance in energy trade. In India, refineries have been operating below full capacity for years, not due to lack of demand, but because of uncertainty in supply. Much of India's heavy crude once came from the Middle East, but geopolitical flare-ups, price shocks, and transit risks through the Strait of Hormuz have made that option increasingly unstable. Canadian oil, in contrast, offers predictability. Alberta's thick crude is a perfect fit for Indian refining infrastructure, and negotiations are already underway to lock in contracts for up to 200,000 barrels per day. This would mark a major step forward in India's energy independence, while also giving Canada yet another major buyer. Japan, facing its own energy dilemma, is moving just as quickly. Long dependent on Middle Eastern oil, Tokyo has grown uneasy watching regional tensions escalate, from attacks on tankers in the Persian Gulf to Houthi missile threats on shipping routes. Japan knows that a single disruption could cripple its energy supply chain. That's why Tokyo is quietly pursuing a long-term agreement with Ottawa, eyeing an initial flow of 150,000 barrels daily. Japan may not be as vocal as China or as populous as India, but its influence in shaping Asia's energy future is enormous, and it wants Canadian oil to be a part of that. Together, these three Asian economies, China, India, and Japan, are forming what many analysts now describe as an informal energy bloc. It's not official. There are no treaties. But the alignment is unmistakable. They are securing stable, long-term access to one of the world's largest sources of heavy crude. And they're doing it outside of OPEC, outside of traditional Western frameworks, and without needing Washington's blessing. For Canada, this diversification is nothing short of a diplomatic jackpot. No longer shackled to the ups and downs of U.S. policy, Ottawa is gaining something it has rarely had in the global oil arena: bargaining power. With multiple buyers competing for access, Canada has more leverage over pricing, contract terms, and infrastructure investments. It can now negotiate as a supplier, not a subordinate. Ports like Vancouver are seeing increased traffic. New shipping terminals are in development, and oil tanker routes across the Pacific are busier than they've ever been. But this new momentum isn't without its challenges. Building trade relations across vast oceans means dealing with new regulatory frameworks, maritime insurance risks, and political balancing acts between rival Asian powers. And with every barrel shipped east, tensions rise in the corridors of power in Washington, where the quiet loss of energy influence is beginning to sting. Still, the facts are impossible to ignore. The global center of oil demand is shifting east. And Canada, once a quiet player in America's energy shadow, is now stepping onto the main stage, with multiple suitors vying for its resources. The question now is whether this new role can be sustained, or if it will spark a backlash that could once again alter the course of Canada's oil future. Back home, Canada's rapid pivot toward Asia hasn't been embraced by everyone. In fact, it's triggered a fierce wave of resistance that's now gaining national attention. While government officials in Ottawa and executives in Calgary celebrate rising exports and stronger international ties, communities across British Columbia and Alberta are voicing deep concerns. And they're not just making noise. They're fighting back with legal action, public protests, and political pressure. At the center of this storm is the Trans Mountain Pipeline expansion, the same project that made this global shift possible. Its completion has enabled tankers to carry crude oil from Alberta's oil sands directly to the Pacific. But every kilometer of that pipeline runs through land that has been contested, protected, or promised. Indigenous groups, whose ancestral territories are directly affected, have filed lawsuits claiming a lack of proper consultation and violation of treaty rights. Environmental activists, meanwhile, are staging nationwide demonstrations, warning that expanding fossil fuel exports in a time of climate emergency is both irresponsible and short-sighted. These aren't just fringe voices. Public opinion across Canada is sharply divided. A growing number of Canadians, particularly younger generations and urban voters, are demanding a serious commitment to renewable energy. They point to rising global sales of electric vehicles. 20% of all cars sold in 2024 were electric, and that figure is projected to climb rapidly. China, now one of Canada's top oil customers, is leading that charge, aiming for 50% EV adoption by 2030. Critics ask the obvious question: If your biggest buyer is racing to phase out fossil fuels, how long will your oil exports remain viable? The fear is clear that Canada is doubling down on a resource whose best days may already be behind it. If demand drops faster than expected, the country could be left with billions of dollars in stranded infrastructure. Entire communities that depend on oil revenues could face collapse, and the environmental cost, more emissions, more spills, more destruction of natural habitats, may prove too high a price for short-term economic gains. Then there's the international fallout. Canada's growing energy relationship with China is starting to raise eyebrows in Washington and Brussels. Western allies, already uneasy about Beijing's global influence, are watching Canada's eastward shift with increasing suspicion. There are quiet discussions in diplomatic circles about the potential for sanctions or restrictions on Canadian oil firms that deepen partnerships with Chinese state-owned enterprises. Some U.S. lawmakers have even floated the idea of using financial regulations to limit the flow of investment capital to Canadian energy projects, especially those seen as undermining North American energy unity. At the same time, the clean energy transition is gaining speed. Solar and wind energy are cheaper than ever. Battery storage is improving. Climate policies are hardening across Europe and the United States. The narrative is shifting from how to produce more oil to how to survive with less. And in that context, Canada's strategy looks increasingly risky. Yet, despite all this, the oil continues to flow. Tankers leave Vancouver daily, bound for Asia. The money is coming in. The headlines are glowing in some circles, but underneath the surface, questions are building. Is this just a clever play to buy time? Or is it a bet on a world that may no longer exist in a decade? As Canada races to seize its moment in the global oil market, the stakes have never been higher. On one side, the country is finally stepping out from the shadow of its southern neighbor, building new bridges to the fastest-growing economies on Earth, gaining leverage and asserting its independence. On the other, it's entering a volatile new chapter defined by legal risks, climate pressure, and the unpredictability of global alliances. With Trans Mountain humming at full capacity and crude shipments to Asia hitting record highs, Ottawa's pivot is no longer theory, it's reality. But whether this is a bold masterstroke or a dangerous gamble depends on what happens next. Will Asia's hunger for oil outlast the world's push toward cleaner alternatives? Can Canada profit in the short term without sabotaging its long-term future? And perhaps most importantly, is this the beginning of a new energy era for Canada? Or the final lap of a fading one? The world is watching. Washington is recalculating. Beijing is maneuvering. And somewhere in the middle stands Canada, balancing economic opportunity with political consequence, environmental backlash with diplomatic ambition. It's a high-stakes play with no guarantees, and the next few years will determine if Canada's oil reboot becomes a success story or a cautionary tale. So what do you think? Is Canada redefining its role on the world stage? Or is it clinging to an industry already in decline? Will this eastward pivot make the country stronger or more vulnerable in the long run? Let us know your thoughts in the comments. We want to hear from you. And if you found this deep dive helpful, hit that like button. Subscribe for more global energy and policy breakdowns, and don't forget to turn on notifications so you never miss a shift in the geopolitical landscape. Thanks for watching,